Okay, welcome to Chapter 7. Chapter 7 will be shorter than Chapter 6. I don't know, maybe it just covers easier topics, or maybe there's less in the chapter, or maybe a little bit of both. But you're going to see that the last video we cover in this chapter isn't really covered in the book, and if it is, it's definitely not covered in Chapter 7. It's scattered hither and yon. But these things that we're going to cover are on the CPA exam, so I can't let sleeping dogs lie. Anyway, let's get going. So this is really part 2, losses and bad debts. So think of it, we're continuing down this path of things that we can deduct. And, you know, we talked about 162 breaking open the doors for deduction of business expenses. And then we went through things that are non-deductible statutorily. And then we went through things that maybe are not deductible or have limited deduction due to having some sort of personal component associated with them. And even though we're not entirely done with that, you'll see when we get to self-employment expenses and we talk about things like travel and entertainment and meals, we're gonna stumble into these areas again. But now we've departed a little bit beyond that land, and we're more talking about things that are deductible, but maybe have a unique treatment. All right, so maybe they should call this special losses. Let's get going. Okay, so always bears repeating to say that, that personal losses are not deductible, again, with a few exceptions. Investments, right, are losses on investments because that is considered a profit-making activity. And the other one is casualty and theft losses. And we're going to spend some time on that topic today, even though they're fairly restrictive these days. I think there's some sense that an expanded version of the casualty and theft loss will return. But, you know, if I had a crystal ball, right? Again, personal gains remain taxable. Business losses generally deductible. Business gains generally taxable. Okay, let's dig in. So the first thing we want to deal with is bad debts. And bad debts from a tax perspective are completely different than the allowance for credit losses that you take now for book accounting. So it used to be called allowance for doubtful accounts. Now it's the terminology these days seems to be allowance for credit losses. And there's no such thing as an allowance for bad debts for tax purposes. Until you write it off, you don't get a deduction. So for cash basis taxpayers, this is kind of a non-event, right? Because they don't generate accounts receivable because they're cash basis taxpayers. And since they don't have accounts receivable, they don't have basis, there's nothing to write off. And so really bad debts are pretty much exclusively from an AR perspective, from sales of your ordinary business stuff, limited to accrual-based taxpayers. You must have a bona fide debtor-creditor relationship, right? So there can't be situations where you pretend like it's a loan when really you've gifted it. So this, we saw that there's this imputed interest issue with, loans between family members that are at lower than market rates. Well, as you can imagine, there's scrutiny placed on related party loans that may go bad as well. Was it just a gift, right, as opposed to a bona fide debt that went bad? Or was it, if you're giving it to your corporation and you really had no expectation of repayment, was that more like equity than it was a loan to that corporation? So there's a classification of business versus non-business bad debts, and the classification is important because, as we're finding over and over again, we treat business versus non-business transactions differently from a tax perspective. So if you have a bona fide non-business bad debt, you treat that as a short-term capital loss. It does not matter how long the loan's been outstanding. You just simply treat it as a short-term capital loss. As a function of it being non-business, if it becomes partially worthless, you cannot deduct that amount. You have to wait until either the whole thing's written off or the amount you're going to collect has been collected. So you can't go through this process of being like, well, I think, they're not going to be able to pay me, 25% of it, so I'm going to write that off. No, can't do that. You got to wait till they pay you the other 75%, and then you can write it off. Business bad debts are a very different matter. They are generally ordinary, and you may deduct partially worthless business bad debts. So if you have customers that don't pay you, or they pay you a part of it, you can write off the other part. What we do know is that it's extremely difficult to get business debt treatment for individuals except through a trade or business. So let me give you an example. Joan loans Betty $10,000, and Betty's going to use that money to start a new business. But unfortunately, like many new businesses, Betty's fails, and as a result, she's unable to pay Joan back the $10,000. Well, even though it was used for business, that is considered a non-business loan for Joan, and as a result, it would be treated as a non-business, so short-term capital, not partially deductible, et cetera, et cetera. Really, the only way to get business treatment as an individual, as a person for your debts, is that if you're in the business of loaning money. So you're a bank or a financial institution or a loan shark that loans money as your business. Okay, another interesting rule, and for whatever reason, this book's kind of weird because it's going to raise the specter of worthless securities over and over and over again. This generally relates, we think of it as relating to equity securities, but it can equally is applied to debt. Securities is a broad term, broader than just equity securities, and you treat those as if they are worthless on the last day of the year. So irrespective of when bankruptcy was declared or when you decided that that security became worthless or when its price went to zero, you treat it as if you sold it for nothing on the last day of the year. As a result, it's generally, because most security investments are treated as capital assets, so it's probably going to be subject to that $3,000 cap loss limit that we talked about back in Chapter 1 for individuals. All right. So maybe we'll do this one more thing and then we'll take a break from this video. What I want to do is talk about a special code section called 1244. And 1244 relates to losses, and there's a similar but different treatment code section called 1202 that we'll cover later on that relates to gains. So Gary starts a business as a sole proprietor, and so he's the owner of all the assets and the liabilities because there is no separate entity. And let's say that Gary's business fails. Well, generally what's going to happen is the sale of all of his business property at a loss is going to be treated as an ordinary loss, and that ordinary loss will flow through to Gary, and he'll be able to deduct those, and they won't be subject to kind of the trappings of capital gains and losses. Sandy, on the other hand, starts her business as a corporation, and the corporation is the owner of all the assets and liabilities of the business. And again, the business fails. So what does Sandy end up with? Well, she ends up with worthless stock, which is treated as a capital loss and is limited. So to some extent, 1244 is an attempt to try to level the playing field. And this is particularly true of small businesses, right? That's what it's generally designed to handle. And so what happens is the sale of 1244 stock at a loss, you can treat as ordinary, as opposed to its typical treatment, which would be a capital loss. So what is 1244 stock? Well, this is stock issued for money or property in a domestic small business corporation. Well, what does small business mean? Well, for purposes of this code section, small business means that the issuance can't have exceeded $1 million at the time the stock was issued. This stock must be original issue. You must be a founder. You can't have bought it on the secondary market. And the company that failed, if you will, that you're selling at a loss, must be an operating company. So what that means is it can't have been a passive income company. And when we get to passive losses, you'll see maybe where that's coming from. But basically, it had to have been engaged in some sort of business activity. So in order to further cap this loss, because again, it's designed to treat small businesses, the amount of the ordinary loss deduction on 1244 stock is limited to the actual loss and may not exceed $50,000, except for if you're married filing joint, and then it may not exceed $100,000. So that means you can get ordinary treatment on up to 50 or 100 if married filing jointly on the sale of this Section 1244 stock at a loss. All right, so before we engage in casualty losses, let's just end Part 1's video right now.